Just playing hi-hat there with the intro music. Hey, everyone. Welcome to Chart This with Dave Keller. Happy Friday, May 30th, the last trading day in May. Now behind us. Hope you guys are all doing well. We're coming to you from a kind of beautiful Redmond, Washington. Nice sunny day, high in the low 70s. I'll take it. This is usually what this area of the country is like for the next 4 or 5 months, and it's just absolutely lovely. And I'll take it. Hope you guys are all doing well. Getting through today's market environment, we're going to do a brief market recap, and then we'll spend the rest of our time together today answering some questions. Got 6 questions that I pulled out of the ones we received here this week, and I would love to share them with you. Please keep your questions coming. As a reminder, all these questions come from people like you watching the show, either lobbing a question in during the live stream or just putting it on our YouTube channel in the comments section. Every question is so welcome. Great to see what you guys are struggling with, what you're running into, what charts and indicators and techniques you're thinking about, and I handpicked some questions to review. A couple quick announcements before we get to the market recap. First off, I was in the Stock Charts TV studio earlier today recording the top 10 charts to watch for June 2025 with my friend Grayson Rose. It was a lot of fun. 10 interesting charts. We talked a lot about risk management, risk versus reward, different moving average techniques, offense versus defense, some macro themes, and a lot of other stuff. So keep an eye peeled for that on the Stock Charts TV YouTube channel, hopefully posted today. And if not, I'm sure it'll be out on by Monday. The other thing, my latest episode of the Market Misbehavior podcast with Tom Bowley just went out this afternoon. I've known Tom for a number of years, a fellow Stock Charts contributor. So enjoyed interviewing Tom with some good frequency. And last talked to him at the beginning of the year. And so it was really cool to just check in on what we've all experienced and some really interesting proprietary work he's done on intraday movements in different sectors versus the close to close movements. Watch that episode to learn more about what I just described, because I thought it was a really interesting indicator to pay attention to. But Tom's awesome and said some really good calls here in 2025 for sure. So that's on my YouTube channel called Market Misbehavior. With that in mind, let's get to the market recap. So looking at the markets here, again, sort of a V-shaped day today. Between the open and kind of lunchtime Eastern time, the market dropped. S&P touched 5850, slightly below that by the close. We're back up to retesting Thursday's close. At the end of the day, we did not go really anywhere at all. Half a point on the S&P, less than 0.1%, almost 0.01% is what the official number was. So basically unchanged today again, but a lot of movement during the day. The Dow up just a tiny bit. The NASDAQ down slightly. This is a pretty quiet day. Mid caps and small caps both down about 1/3%. The VIX continuing to drift lower, remaining below 20, which is that volatility threshold we like to keep an eye on. Rates were kind of mixed today. The bond markets were very, very choppy, but directionally really didn't go anywhere. I mean, this summarizes, I feel like, the sentiment in the market right now. As I'm prepping for the show, there's another headline. I didn't even get a chance to look at it. About some sort of tariff announcement, maybe on steel companies. So the flurry of headlines continues. These Friday evening ones have been some great ones because then we have the whole weekend to sort of debate and discuss what the impact might be. So we'll see what happens. Dollar basically flat for the day. So this is not a big directional day across the board. Precious metals, gold and silver were down quite a bit out of the open. The first 30 minutes was pretty rough for the GLD and the SLV, but by the close, they'd regained about half of that initial loss. So the GLD finished down about 0.7%, silver down 1% in the commodity space. Cryptocurrency is not looking particularly good. Bitcoin was up around 109,000 during the day yesterday. By the time we were doing the show, it was back toward in the 106, 107 range. And as of right now, we're dipping below 104,000 as we go into Friday evening. West Coast time here, you can see most of the top 10 coins tracked on the Stock Charts platform in the red. Now, obviously, Bitcoin is its own thing, and cryptocurrencies are their own market, basically, but they've generally been, more leverage plays on risk, right? It's pretty much speculation that's generally driving the value of these things day to day and week to week. And the fact that we're seeing kind of a risk-off rotation in Bitcoin and Ethereum, while stocks are kind of holding their ground, maybe this is a sign of lack of upside follow through for stocks to come next week. We'll see. I would argue one of the big themes, and this is something I just wrote an article about on stockcharts.com. If you go to my blog called The Mindful Investor, you can look at some charts I just shared about sector performance here. And in the last month, the three top sectors have been industrials, technology, and consumer discretionary. It's been technology number one, then industrials, then consumer discretionary. You can see those three all in the bottom half, and two of those down, a decent amount today. The defensive sectors have not been particularly good, but this week, a number of days, we've seen things like utilities and consumer staples, REITs, appear toward the top of the list. So just in the last week or two, I think we're starting to see, as the market has stalled out, as the S&P and the NASDAQ are kind of sideways here in the last week or two, we're seeing some rotation with some of those leading sectors off of the April low starting to underperform. Some of the defensive sectors that have been underperforming in this rally phase are starting to improve. So I would argue that's probably the most important theme to be paying attention to going into June, is if we see further rotation. And we'll talk about that in a little more detail with our premium members in our weekly flight plan over the weekend. By the way, definitely consider that if you're struggling to make sense of these markets, you need some help navigating them. Our market misbehavior premium memberships, a fun way to do so. Great opportunity to learn more about the technical and behavioral toolkits, to get some custom or some premium reports where I share some of my best insights on what areas we're seeing opportunity, and a lot of educational content as well. And then you'll have access to our members community to ask questions anytime you need. You can find more info at marketmisbehavior.com/premium. Don't forget to use the code YouTube for a special deal on your first 12 months on any plan. Looking at the Magnificent Seven and Friends here to finish off our market recap. Netflix up almost 2% today. Apple and Meta up about a third, 0.5%. Microsoft as well. On the downside, though, this is the real problem with the space. Tesla down over 3%. Nvidia down 3%. After Nvidia's incredibly encouraging earnings report on Wednesday after the close, Thursday and Friday have not been particularly good for the stock. It's actually been rotating lower here. So we have the S&P sort of in this stalled out motion. We continue to see this shaded area. I don't have it shaded, but the gap range from earlier in May, which includes the 200-day moving average and that swing low from last week, that's last Friday, continues to be pretty important here. I think you'd probably call that a hanging man candle on the S&P. The fact that it's generally happening in an uptrend and happening toward the highs there of that stretch, that's not encouraging going into next week. With that in mind, shall we get to some questions? All right, question number one. And again, thanks for sending these in during the live stream. Pop them on as we're on whatever platform you're watching the live stream. If you're watching the replay on YouTube, just put a comment below the video with your question. We'd love to hear from you. Hope to answer one of yours in our next mailbag episode. Question one, has healthcare ever flipped to an offensive sector? And if so, what should I look for to notice if that process has begun? That's a really great question. And, to be honest with you, I would say it's imperfect to describe sectors as pure offense and defense, right? I mean, these are generalizations that we're making. And we make a lot of generalizations like that simply because the markets are pretty crazy and they're pretty complex. And you have to give some structure to what you're seeing, or you're going to go crazy trying to make sense of all the movements that we can track. So I have sort of developed my own strategy, and there are others that have different ways of thinking of this. I know I think it's Morningstar has like an official grouping, three groups of sectors, and I don't really know how well that matches up to what I'm doing here. And I've looked at it before, so I should know that, but I didn't let them look that closely. So I think of it as three buckets. You have growth, value, and defensive. And again, I mean, it's not perfect, right? But I mean, these are just general ways to think about it. The three growth sectors: technology, communication services, consumer discretionary. The four value sectors: industrials, financials, materials, and energy. The defensive sectors: utilities, healthcare, consumer staples, and real estate. That's a good way to just generally think of those buckets. Now, having said that, they don't all trade the same all the time, right? And sometimes financials are a great defensive play, or utilities are a great offensive play, right? And what I mean is there are times when utilities have actually performed quite well in bull markets. 2014, if I remember right, is a great example of that. A bull market where utilities and real estate were the top two performing sectors. Look that up, but check me on that. But I'm pretty sure that's right. If I remember my my market history, because it was such an anomaly, right? You had a bull market, but the stuff that shouldn't be outperforming in a bull market was outperforming. You saw that last year with the AI trade in early 2024, and you saw like utilities do quite well. And it turned out there's sort of that theme of the energy requirements and electricity requirements to fuel AI and crypto mining and all of that. But on the surface, it's like utilities are a pretty defensive sector. They're a low volatility sector. What are they doing outperforming? So these are generalizations. Having said that, yes, particularly about healthcare. Healthcare is sort of an unusual one, and I have it bucketed with defense, but it's not all defensive. Like some areas of the healthcare sector, I think like Johnson and Johnson, well-established, type of company, healthcare products, but, very well entrenched in a lot of people's thinking, sort of an old school blue chip name, pretty defensive. But within healthcare, you also have like biotech, which are super risky and super high beta, and very much like a risk on type of position, because when things get rough, people don't usually pile into biotechs, right? They tend to underperform in bear market phases. So even within healthcare, there's not a lot of clear differentiation. So I would say the times when healthcare ends up being more of an offensive sector is when biotech does so well that it starts to perform well. Now the market cap in healthcare, the XLV, is usually more in pharmaceuticals like Merck and Johnny John and those types of. Those are the big Eli Lilly. Those are like the big names in the space based on market cap. But biotech, stocks like Amgen are decent size, and so they can move the needle a little bit. So I mean, if the rest of that sector is kind of flat and things like biotech do very well, all of a sudden healthcare tends to play a little bit more like an offensive sector. If you look at the last year, right, and this is a 2-year chart, so just start here and look to the right, healthcare, which is blue, you can see generally matches the relative performance in utilities and consumer staples and real estate. So it really has been behaving more like a defensive sector in the last 12 months or so. So it really is. I mean, each sector kind of has some. I mean, many of the sectors have some more offensive and more defensive names. Like in communication services, you've got media names and internet companies like Meta, but you also have old school telecoms like AT&T and Verizon, all in the same sector. So within the sector, you'll find some different offense versus defense. But so I hesitate at times to just say healthcare is a defensive sector. That is a generalization. It's not always true. Sometimes it will not perform like it. But if you look over multiple cycles over many, many decades, generally speaking, it tends to be a little more defensive, and that's why. So what I would look for is I would look particularly at biotechs, which is the more offensive area of the healthcare sector. Great question. Question number 2, can you discuss hidden divergences on indicators? Do they work the same way on all indicators? I really don't like this question. And I nothing personally against whoever asked it. I appreciate you asking about it. Hidden divergences are one of those things that I find a lot of people talk about them, and I see that a lot on YouTube channels that I would humbly suggest are not well. I don't like to talk negatively about anyone's work. YouTube channels I would not personally follow, right? I mean, if you think of the guests that I bring on my podcast and people in my network, these are really good strategists and money managers whose work I think, traders who have had successful careers and I think deserve your attention. The bad news about the internet in 2025, there are a lot of people that I would argue don't deserve your attention, but they have a megaphone and they can get their message in front of you. Hidden divergences I often see picked up by a lot of different channels and commentators, and I don't find them particularly valuable. I'll show you what they are. For some reason, people are very attracted to them. I haven't figured out why, because, I mean, in my own experience, they're not that helpful. But again, you'll ask, and so I'll answer. So let's start with what an actual divergence is, right? Which would be when, so there's a chart of Apple. A classic divergence would be, in an uptrend, the price is going higher, the RSI is sloping lower, right? That's a bearish divergence. A bullish divergence would be lower prices and a higher indicator. So hidden divergences are kind of the opposite, right? So if you see higher prices in an uptrend, but lower momentum. So this isn't perfect, but this example, like September to early November, you see how Apple's going up and you're making higher lows, but then the RSI is kind of sloping downwards. It's not much, but I mean, like, imagine this was a little bit lower. That would be what's called a hidden divergence. The argument being it's bullish because you're basically, the price is going higher, the indicator's going lower. This is setting up for a catapult move to new highs. That doesn't make a lot of logical sense. I mean, I think that's the problem I have with that particular line of thinking. For me, divergences are meaningful because in an uptrend, momentum is dissipating, right? So in an uptrend, you would assume positive momentum. It's not happening, and so that's usually the sign that whatever momentum was causing us to be in this uptrend is starting to dissipate. And you see that with Apple, with most of the major turns we've seen here. You'll see bearish divergence, and that's why I think it's so helpful. Hidden divergences are very hard to pick out. Classic divergences, it's now impossible for me to not see that divergence. Like, it's just so clear when I look at the chart. Like, I immediately see it and then start to think about risk versus reward. Something like this, I've even pointed it out to you, and it's not 100% clear that that's what it is. So, and again, it's called a hidden divergence, probably for a reason, because it's really kind of hard to pick out. So the logic of it is what doesn't mean a whole lot to me. I've not done like any testing on that. I've not used that approach often enough to tell you, boy, it really doesn't work, and here's why. I've not found a need to include that in my thinking. I don't feel like I've missed much because, and I guess maybe why is when we go higher and the momentum sloping downwards, like, I already know we're in an uptrend, so I don't know if I need a hidden divergence to tell me that uptrend is continuing, I guess. Boy, I'll do some more thinking of it. And if any of you have found a really interesting, compelling, credible source that shares wisdom on why hidden divergences are so awesome, let me know. I talk to them, but in my own experience, it's not my favorite. And again, I'm not sure why certain places really gravitate toward those. Maybe because it's hard to pick out, and so it's meaningful to identify them. I'm not sure. Next question: for analyzing relative strength for a stock like Amazon, would you prefer XLY or the Dow Jones Industry Group as the basis of comparison? I mean, really, really interesting, right? So when I bring up a chart like Amazon on stock charts, my default kind of go-to chart is a 2-year daily chart, RSI, which is a measure of momentum, and relative strength or relative performance. So Amazon versus the SPY. And I think what you're asking about is, if you want to understand Amazon like versus other consumer names, what should you put in the denominator? And you're saying XLY, which I can get by putting that in here, or I could just say sector on stock charts, and that's automatically going to bring in the sector of whatever I bring in. Or I think you do industry. Yeah, so here it's bringing up DJUSRB, and I don't even know what that official one is called. What is this? Broadline retailers. Okay, that's the Dow Industry Group where stock charts has bucketed Amazon. So this is Amazon versus the industry group of broadline retailers. Here's Amazon versus consumer discretionary, and here's Amazon versus the S&P 500. So as you can probably tell, if you watch the show for a while, I usually default to the S&P, because for me, when I'm looking at that line, I'm basically thinking, does it help me to own this stock versus just investing in a core position, just having my money in the S&P, which is kind of my default, just thinking of that. It's not always, but let's just assume that's like your default equity position is the S&P. So do you want to take a little bit of that and put it in an individual name, right? And so that relative performance line helps me make that assessment as to whether or not that stock is helping me outperform the benchmark. Now, having said that, I think there's a lot of value in looking at some of those other comparisons. Gaddis Rose years ago shared this chart with me that basically combines some of the things that you asked about, right? So here is Amazon versus the VTI. So he uses the VTI, which is kind of like the S&P with just a lot more names, but very, very tracks very closely to the S&P. So Amazon versus the total market. And then skip that one. Here is Amazon versus that Dow Industry Group. We're really not showing Amazon versus the sector, but that would be a third one we could maybe show here. Here we're showing the sector versus the benchmark, the group versus the sector. and then the stock versus the groups. The idea with these is just to think about different relative, comparisons. So am I in a stock that's outperforming the market? Is the sector that it's in outperforming the market? Is the industry group outperforming its sector? Is the stock outperforming its industry group? And I think if, to go like another level down, that's why I have this saved as a separate chart that I don't bring up all the time, but I sometimes do. And if I want to dig a little bit more into relative performance, or if I know semiconductors are doing pretty well, and I think NVIDIA is an interesting chart, and I just want to get a sense of how is NVIDIA stacking up to other technology names? What about other semiconductor names? How are semiconductors doing overall? These relative performance ratios help you do that. So for me, I'd probably go in priority order from, versus the S&P to versus the sector to versus the industry, because I tend to go big to small or macro to micro. So starting with the overall, what's the big, how's it performing versus everything? How's it performing versus the sector? What about the industry? But I would say all of these can help you understand nuances of where the performance is coming from. And I think that's, if you identify Amazon's a good chart and it's outperforming, well, are all the broadline retailers performing, or is it just consumer in general is doing very well? Or, understanding a little bit more. I don't always need to have that granular understanding of relative performance, but when I do, I think charts like this are helpful. And, the way you create all the different combinations that I've shown here are just using the argument, at least on stock charts, $ symbol, $ industry, $ sector, will automatically bring that in for different symbols that you bring up for that chart. All right, we're going to keep going with the next 3 questions here in a moment. I do want to remind you, by the way, I promised my friend George Noble I would help him promote his conference coming up. He's doing his first ever independent research conference. George, if you don't know him, he's actually going to be on my Market Misbehavior podcast in the month of June, which I'm pretty excited for. George was the first international portfolio manager at Fidelity. He started that in 1984. He launched the Fidelity Overseas Fund. He was Peter Lynch's assistant before that for a couple of years. And so really kind of an old school Fidelity money manager. He's gone on to run some successful hedge funds. And now he's highlighting some of the people that he thinks highly of in the independent research space, including John Roque from 22V Research, who John's awesome. He's an exceptionally good technical analyst. He's worked on the buy side with people like Paul Tudor Jones, on the sell side at Natexis Bleischroeder and other shops as well. I interviewed him about a month ago on my Market Misbehavior podcast. Awesome, thoughtful technical analyst with some great experiences to share. Others like Jay Pulaski, who started the asset allocation team at Morgan Stanley, Michael Howell of Cross Border Capital, and a bunch of others. You can find more information at noble-capevents.com, noble-capevents.com. Make sure you use the code SAVE100. You can get $100 off your price of admission. I'll include a link in the description in the links below the YouTube video if you want to check it out. George is great. Excited to have him on the podcast here very, very soon. Hope you can check out his conference as well. It's an online conference, by the way. It's from wherever you're tuning in from. All right, next question. Is there a proper condition to play 3 times leveraged ETFs for a few days without fear of decay? I hope you make a lot of investment decisions without fear, right? I mean, that gets to really, just the nature of your question is very telling, right? If I'm a therapist, I hear the way you're asking your question. I'm like, ooh, does it make you afraid to buy those, to buy those leveraged ETFs? Why? And to be honest with you, I hope with what we talk about here on my Market Recap show, on my podcast, with all my content at Market Misbehavior, I know I try to reinforce this with our premium members often, is that, we want to get from an emotion-driven process to an evidence-based process. Get away from, I'm afraid, I'm nervous, I'm excited, and then I have to take action, and get it to the weight of the evidence is telling me I should be making this trade. They seem very similar. They're actually remarkably different in terms of making sure that your trades are motivated by the right, I think, evidence, right? Evidence over emotion. So, I hope you don't have fear. Now, your point is, you're just talking about the natural decay. So, when you're looking at triple leveraged like ETFs of any sort, right? So here's the SQQQ, which is a triple short NASDAQ 100 fund. I don't own this, by the way, but I will tell you one of the top 10 charts. I mentioned Grayson Rose and I recorded that video earlier today. One of us, I won't tell you who, Grayson Rose mentioned playing the short side on the NASDAQ. So I'll leave it to him to explain his justification. Not my idea, but his. We didn't talk about the SQQQ though. We talked about a different ETF there, but you should check it out. What is there a place for these? So yeah, I mean, what you have to remember, number one, with any inverse or leverage ETF, and you're not talking about inverse ETFs in particular. You're talking about leverage ETFs, but I think either way it's important. What you have to remember is these were not designed for long-term holdings, right? They were not designed for you to buy something like this and hold it for weeks and weeks and months and months. Although a lot of investors I found definitely do that. Just the problem is they don't track things probably how you'd expect, because the way that these are designed, this is basically designed that every day it gives you triple inverse the move in the NASDAQ 100. So if like the NASDAQ 100 is down 0.2%, this should be up 0.6%. That's what it's designed to do. It doesn't always track perfectly, but that is what is kind of designed to do by the structure of the ETF. Now, the problem is when you then string a bunch of days together, those daily percentages may not track to the larger percentage moves that you may expect. And so your year-to-date performance on an ultra short NASDAQ 100 fund may not track exactly what you'd expect, because the math doesn't work the same way when you're looking at longer periods of time. It's just meant to have that exposure, that leveraged exposure to one day. So I would say that's part of it. Depending on what ETF and what structure you're looking at, you always want to do your due diligence on how they're actually giving you that exposure, what risks are involved, liquidity risk, et cetera, just to make sure, because and also the fees, the spreads, all of those are part of, I think, the normal due diligence process of validating whether a particular stock or ETF for sure, is something that you should include in your portfolio. I mean, for a couple days, which is what you asked about, yeah, that's what these are actually designed to do, is give you that leveraged exposure over a limited period of time. I would tell you, and again, can you hold it theoretically for months and months? You could, if and I'm thinking of like the TQQQ this is like the Ultra Pro, so like the triple levered or a triple levered NASDAQ 100 ETF. If you really think the NASDAQ 100 is going to go up a lot from here, you're going to gain a lot more in that upswing with the triple levered ETF, right? I mean, it's just by the math, that's probably how that's going to work. Having said that, there's a lot more risk. So if and when it turns down, you're gonna face major drawdowns with the TQQQ that you wouldn't get with the regular ETF. So that leverage works on the way up, but it also works on the way down. Same problem with using like a margin account. It can be very helpful as long as your trade continues to progress as you want it to. But when it doesn't, the other side can be really, really painful. And most people hold on to it way too long, and then they end up, having to deal with that side of it as well. So generally speaking, yes, I would say the math will work out pretty well. Decay is not a huge issue with 3-time with leveraged ETFs on a few days. We're talking about a few months. Those are very real issues, and I would encourage you to do some due diligence. But besides the structure of the ETF, look at some historical periods when the NASDAQ was going up and then reversed downwards very aggressively. Look at the percentage losses that you see in this versus the QQQ itself, and just understand that relationship is what I would suggest to you. Next question. Oh, this is a meaty one as well. What do you think about Bitcoin? Is it something worth investing in? Not just the charts, but is it something that could potentially have long-term value and have mass appeal in society? And I've had a number of questions along these lines here as we've talked about, at times to track the performance of Bitcoin. And I randomly throw in like what I think the thesis is on Bitcoin. And full disclosure, I do own Bitcoin. I own Ethereum through Coinbase accounts. I own the GBTC, IBIT. I own both of those Bitcoin ETFs. I've held GBTC for quite a long time, and IBIT I added earlier this year. And I think the argument. And again, I'm not making. I certainly don't want to make a recommendation, and certainly do your own work and your own analysis to determine whether or not something like that could make sense for you. But for me, the reason why I own something like Bitcoin, it's a mix of the technical setup and the kind of, structural macro fundamental sort of reality, right? So and you had a much longer question, and I had a couple questions, so I kind of summarized them into this one question that was a part of what one of you asked. What's the thesis, right? I mean, I think the non-technical argument for something like Bitcoin is it's proving to be a store of value. It's proving to have wider and wider adoption. People think it has value, so it does. And if you think that sounds unreasonable, things like the dollar and the yen don't work that much differently. I mean, the structures are obviously very different in terms of a central bank that is running those currencies versus a decentralized, structure. Granted, totally different. But in terms of why Bitcoin is worth $104,000 a Bitcoin, it's because we all think it does. And if people don't think it does, they'll sell Bitcoin and the value will go down. And if people think it's worth a lot more, they'll start buying Bitcoin and it will go up. And the same thing happens with the dollar. More people want dollars, they convert to dollars and the value goes up. And that's just the nature of how different current, there's other things like an interest rate differential, but I'm summarizing, right? I mean, the dollar is not a gold standard anymore. You can't go to a bank and get gold for your dollar. It basically does not have a physical thing. The piece of paper has value because we think it does. And the digital version of dollars that you have in your bank account has value because we think it does. Gold has a certain value because we think it has value. And again, the markets, I guess, in that way are more fragile than you probably realize, right? A lot of these just have value because people all agree that they do. But that's how the financial markets work, is to transact those changing expectations of future value of those different assets. So long-winded way of saying the long-term story with Bitcoin is the technology, the blockchain technology. I think and that's what is the backbone of Bitcoin and Ethereum and all the other, most of the other cryptos. I would say with Bitcoin in particular, it is actually starting to have some practical value. You can actually buy things with Bitcoin. You can, transact things. It's actually pretty easy to get Bitcoin now, whereas before you had to have a digital wallet and a code, and it was, questionable as to how secure it was. Now there are fairly secure ways to acquire some Bitcoin and have it and use it to, as an exchange of goods and to gain goods and services. So the more that's happened, the more that there's institutional backing for it. So the fact that in a brokerage account, depending on your broker, you can actually, have a digital wallet as part of your, account displays. The fact that more and more institutional investors are starting to warm up with it. Financial advisors are talking about, gaining exposure through ETFs that are now widely available. I think all those things sort of give it more upside potential. So I think the long-term story is it's a different way of having something of value. Think of what gold is. Does gold have any practical value? It really doesn't. It's pretty and shiny, but it really doesn't do anything. Bitcoin doesn't do much on its own either, but neither does the dollar, but it has value because we all agree that it does. That's a long-winded way of saying I think the structural upside is good, but the chart's good. And I think as long as the chart keeps going up, I think that that is the demonstration that people believe it has more value than it did before. Final question. Happy Friday to you as well. Is that a hammer candle for GEV on today's close? And what would yesterday's candle be called? All right. GEV, if you don't remember, is GE Vernova. That's the spinoff from early 2024 when GE split into a couple different pieces, the aerospace part and energy and renewable energy, et cetera, and then the kind of old industrial part of it. So this is sort of the renewable energy section of GE. And you're asking about the candle patterns, which is this. Yeah, so yesterday's candle, we'll start there, is what I would call that a dark cloud cover. And a dark cloud cover, I don't know if there's a good way to make this a little easier to see. And maybe there, right? So a dark cloud cover is you're in an uptrend, you have an up day, you have a down day. Day two has a higher open, but doesn't close below the previous day's open. So if we got all the way below yesterday's open, that would be a bearish engulfing pattern. We have an up day and a down day, and day two engulfs day one's range. But if it doesn't get all the way below yesterday's open, but it gets at least halfway through the real body of day one, that's called the dark cloud cover. If you would see the opposite, which I don't really see here, but if you'd see like a down candle and then an up candle, but it doesn't make it all the way to make it a bullish engulfing pattern. You call it a bullish piercing line, which is a bullish, something you'd see at a lows. This is called a dark cloud cover. It suggests the next 1 to 3 bars are lower, and really didn't do much today. What would I call today's candle? I mean, you could probably call it, I don't know. This is kind of debatable, right? I would probably call that a hanging man candle, because I think the primary uptrend is still up, and you kind of see that candle. If it happened at a low, you'd call it a hammer candle, but here in an uptrend, you'd call it a hanging man. It's not a great example of one, though, because the range is pretty low. So I don't know if I would necessarily be 100% convinced that's the most important candle pattern I've seen. But yesterday, the dark cloud cover, for sure, that's Wednesday and Thursday. And the way that you determine whether that candle is broken is a push above 490 would take us above that 2 candle range. And that would suggest the dark cloud cover no longer as ominous as you originally thought. That'll do it for the week, and that'll do it for today's all mailbag episode. Guys, thanks so much for some thoughtful questions. Hope you enjoyed this deeper dive into some of those questions. Keep them coming, please, during the live stream, watching the replay on our YouTube channel. Put your questions in the comments section. We've got a running list that we like to update with any new questions that come in. And next Friday, we're planning another all mailbag episode. We'd love to answer one of your questions on the show. In the meantime, have a fantastic weekend. We'll be having a normal publishing schedule next week, but enjoy the weekend. And remember, it's always a good time to own good charts. Take care.